Hello, my name is Nigel Sutton. This is a presentation of an IBM solution encompassing prediction, planning and optimization. This solution demo set has been created based on a real customer scenario combining capabilities of 3 IBM integrated components. The example uses planning analytics for both the data store and user front end, which we're seeing an example of now. SPSS Modeler is used to provide a baseline statistical prediction using historical data, and Decision Optimization produces the optimized plan based on the business constraints and goals reflected in planning analytics. In summary, a consensus forecast is required in conjunction with an appropriate production plan and integrated with finance. The demo context is around sales and operations planning for a company that produces motorcycles and is divided into 4 sections. Let's take a look at this in more detail. It starts with a prediction of sales data. Therefore, SPSS takes 3 years of historical data on a monthly basis and creates a prediction, in this case for 1 year. Manual sales planning. That's done by placing delta adjustments to the prediction in posting levels. This can be done by varying business users, such as sales and product management. The system dynamically calculates the final forecast by combining the prediction and any corresponding adjustments. In the operations section, the forecast and other data inputs are used to create a production plan. Decision Optimization uses this data directly from planning analytics to run constraint-based optimization. The optimization can run across multiple versions and essentially determines production quantities and market allocation. It takes all the constraints into account that are given as input data and computes a plan that is optimized with respect to the planning goals. In terms of the input data, we're looking for the available production capacity, so we need to know how many items of each product can be produced in each plant. We're looking at the forecast, both the demand forecast and firm orders, and of course marginal profits for each product and market. And the outcome we're looking for is the production plan, so for each plant and product and month, the number of items to be produced, and the market allocation for each market and product a month, the assigned number of items that can be sold. Inventory, the accumulated inventory, which is the products that are being produced but not sold, and the available products for sale for each product and market, how many products can be sold and yield marginal profit. Overarching all of that are the planning goals. We want to minimize forecast deviation. We want to accommodate the forecast as closely as possible. We also want to minimize production costs. Different costs at different locations carry a different cost of sale. But we want to maximize the sales margin. We want to allocate products to markets such that the overall margin is maximized. The optimization combines all goals into one common goal. Therefore, sometimes one goal might overrule another, depending on the goal weights provided by the business user in planning analytics. Fourthly, in the final section, we're looking at the financial implications of the production plan that is determined. This includes a profit and loss and a real-time cash flow. Back to the predictive forecast. The more historical data you have, the better. Here we are only using 3 years of data and creating 1 year of a predictive forecast. This has been statistically derived, taking into account industry-specific proven practice, outliers of data, and any other business requirements. The predictive forecast is the baseline for the overall forecast. Now, sales can make adjustments to this prediction on a separate posting level. See the changes that are calculated in real time. Sales may also want to make a change for a specific region, and only from August onwards for the UK. Product management may also want to make adjustments on their posting level from a product point of view. These adjustments, as you've seen, can be made at any level. To produce an optimized plan, the various inputs are required. The forecast, so the numbers created by prediction and overlaid with user adjustments, as you've seen an example of. Marginal profits, well, they are calculated automatically by the model. There are parameters, general planning parameters like number of months planned and weighting factors for optimization, and of course capacity information by month and by product. And the results we're looking for are the production volumes and demand allocation of finished goods, i.e. how many to produce where, when, and by individual SKU. Let's continue with the inputs required to produce an optimized production plan. Goal setting allows the user to create a new planning version if necessary, and lets them modify optimization parameters like months planned, the weighting of various targets, etc. We'll be working with version 2, which is already automatically pre-populated based on a chosen version of previous data. On the capacity plan, these are the current capacities by facility, with normal shifts based on line speeds and products produced by facility. On the production plan, this runs the optimization and shows the production results. The prepare optimization step collects the required demand information, the targets we prioritize in our goal setting tab, and our current production capacity levels defined on the capacity plan tab. All of this is added to other constraints such as production line speeds and number of shifts within each production facility. Production allocation is made between time periods to optimize margins, and the returned result is a production plan that we are about to see. However, if we look at the demand allocation results, we can see that inventory is built and balanced between time periods, but with the constraints given, the overall demand forecast cannot be met due to the currently defined production capacity levels. To rectify this, any number of changes could be made to business drivers, constraints, and assumptions against versions of the plan. Today, we'll simply change one element of the data for our version 2. Let's go back to the capacity plan tab and change the maximum value for the capacities in January and February to 40,000 units in total. This decision could be in response to adding overtime shifts at various facilities or retooling production lines. Alternatively, there could even be an opportunity to rationalize less profitable SKUs in an effort to manage mix and deplete existing inventory to eventually replace those SKUs with new and more profitable products. Back to the production plan tab, and I'll send the changed input data to decision optimization and then run the optimization. This action will take a few seconds, then we'll soon see the results directly written back here to Planning Analytics. We can see that the full 40,000 is not being used. And looking at the demand allocation results, the new production plan shows that in January and February, we are now building inventory based on new increased production levels that we can then use to meet our stated demand in the future months. Here, we can see the differences between two optimization results. The value for January now fits the forecast. The capacity raise in January and February leads to an inventory increase, which is used to meet forecasts for the following months. As mentioned earlier, the used capacity is less than the maximum of 40,000. If required, these results can be overwritten using Planning Analytics standard planning functionality. Over to the income statement. This shows the impact of the current planning process on a planned P&L. It contains the affected revenue and cost positions. Revenue is units multiplied by price. Costs is units multiplied by various cost factors. This is all calculated in real time. Looking at the future cash situation based on the plans that have been created, it shows that adding that extra stock in January and February, and also a payment lead time of 1 month, it creates a negative cash flow and a positive for negative cash on hand situation. This raises an action item for the treasurer of the company to talk to the bank to get the cash shortage properly financed or use an existing line of credit. To summarise, we started with our predictive forecast. That was the baseline for our demand forecast. Next, the sales planning team were able to collaborate with the marketing team to add their adjustments for the new market expansion and or new innovations to arrive at a consensus forecast. The operations team then collaborated with reviewing current production capacity and inventory levels to meet the new demand. The operations team leveraged decision optimization to do the heavy lifting and provide a balanced, optimized production plan that meets the consensus demand forecast. Finally, the financial planning team were able to see the profitability and cash flow impacts of these decisions and then take the necessary steps to increase cash on hand and free cash flow before going to Treasury to make further financial requests. That concludes the planning, prediction and optimization demonstration.